welcome. Today we're going to talk about mortgage rates and kind of what the Federal Reserve would look at if they're going to raise rates or lower rates. I'd like to say, first of all, I am not a financial advisor. I'm making no recommendations here. I am a mortgage loan officer with Morty. I originate loans in Texas, Oklahoma, and Florida. And I am not recommending you get a mortgage or not to get a mortgage. That all depends on your individual situation as far as your credit rating, your debt to income, your property, how much liquid assets you might have, your past financial history. Many things can go into that. So we're just going to look at maybe how overall what the Federal Reserve might be looking at and how you can kind of gauge the market. With that said, if we look at the mortgage rates, why would they go down or why would they go up? What are some of the things that the Fed looks at? So let's move forward here. The money supply. So the levels of funds available at any given time, and they go by three different areas: M1, M2, and M3. And the M1 currency in circulation is what they're looking at there. So the demand deposits, the traveler's checks, interest bearing now accounts, which means that when you want your money now, you get your money now. So checking accounts and savings. Okay, M2, you're looking at most followed measure is M2, which includes M1 and savings deposits, money market deposits, accounts, money market funds. M3, we're looking at M2, which includes M1, plus your large CDs, your certificate of deposits. Okay, economic growth. Moderate growth, that's positive. That's what we want. Rapid growth, inflationary, sharp drop in growth, that's recessionary. Interest rates, cost of borrowing money. The type of interest rates, we're looking at long-term rates, short-term rates, super safe securities, junk bonds, nominals, real, inflation adjusted, risk adjusted, effective interest rates or yields. Okay. Interest rates. Interest rates depend upon maturity of the security. The longer the period, the higher the interest rate because of the greater uncertainty. Okay, that's not always the case. We'll be looking at that when we look at the 10-year Treasury. Prime rate. The prime rate banks charge is their best customers and the short-term loans. Sign of rising or falling loans demand economic activity. The prime rate climbs, it means borrowing heavily, economy is still going up. Okay. This will show you, we're looking at, this is bankrate.com. And we're looking at the prime rate here. This is what the prime rate, of course, this week, 8.5. And we're looking at a year ago. Okay, so it did go up from a year ago, of course. And it means the economy is going up a little bit. Okay, federal funds rate, the rate on short-term loans among commercial banks. Fed influences the rate by opening market operations, which means buying and selling treasuries, right? The bonds. Buying and selling bonds, that's what I just mentioned there, by changing the bank's required reserve amount. Federal funds rate, here we go. Last year, 4.75. This year, 5.5. Okay. So they're charging more money. They're charging those banks more money. So the federal fund rate. Okay, discount rate. The charge on the loans to deposit institutions by the Federal Reserve. A change in the discount rate is a major economic event. Impacts security prices, bonds. Change in the prime rate follows the change in the discount rate. And your discount rate is right here. So again, that also went up. Okay. Why did it go up? Well, the Federal Reserve is of course, as you know and you've heard out there, they're trying to slow the economy down. They're trying to prevent a recession. They want a soft landing, of course. So that's why they're raising that. So they're raising the discount rate. A lot of times will affect the prime rate. Okay, so it goes up, this goes up. Okay, moving on. 90-day Treasury bill. Direction of the short-term rates. When the yields on the 90-day bill rise sharply, may signal a resurgence of inflation, economic slowdown. Okay, here is the 90-day Treasury. 3 months, of course. Okay, as we can see in this graph, there's no sharp upturn, is there? Okay, so it's pretty steady, pretty steady. So that's why I think the reserve is thinking that we're not going to really go into a recession, but we'll see. Okay, moving on. 10-year Treasury bond. Okay, so most watched interest rate in the world. The daily barometer of how the bond market is performing. It's a bellwether. Price is decided by a series of dealers. Bond yields derived from the current trading price and fixed coupon rate. Long-term nature, sensitive to inflation. Indicator of direction of inflation. Okay, impact fixed rate mortgages and housing industry. Okay, this is the market watch. I'm shooting this in February 13th. And as you can see, here's your current, and this is a year ago. So a year ago it was lower. Current, it's going up. Okay. Now, how does this affect? Well, a lot of your wholesale lenders, they will go ahead and borrow at the lower, shorter term, 2-year and 3-year Treasury rate, and then they will lend the long term, your 10-year Treasury affects more of your longer term mortgages, such your 30-year fixed. So what they have to do is you really want your long term to be higher than your short term, because if they're borrowing at the short term, they're going to want to lend at the long term. They want to make a spread there. They want to make some money between those two percentage amounts, right? So right now the curve is still inverted, meaning that the 10-year Treasury is lower than your 2 and 3, I believe. Let's look at our 3-year. Okay, so our 3-year is at 5394. 5394 is our 3-year. And let's look at our 10-year Treasury note. Is at 4273. Quite a bit of gap. All right, so it is definitely inverted yet. Moving on from 10-year Treasury bond. Fed's monetary policy tools. Okay, so what can they do? Here's how they adjust the rates. They'll change the required reserve amounts. They'll change the deposit rate, and they'll open market operations by selling or buying bonds. Okay. And what you're looking at, this is the federalreserve.gov. And as you see, they're saying for 2024, the reserve requirements exempt amount will be set at 36.1 million, unchanged from 2023. The lower reserve tranche will be set at 644 million. Okay, so back in, I believe it was 2021, the reserve rate was at 34 million roughly, and they rose that to 36 million. Okay, so what does that do? Well, it doesn't allow banks have to keep more money in the bank. They can't lend it out. And if they do lend it out, they have to have a certain amount of reserves at, I think it's midnight. So that's where the federal fund rate comes in. So they got to borrow money for that day to make sure that they have enough reserves by midnight for just that day from the federal fund rate. And that's how that affects them, because they have to pay it, of course. Fed monetary policy examples. Okay, so the action is the discount rate on the short-term loans to member banks changes. The first effect of that is the banks are likely to start passing on the rate by increasing or decreasing their prime rate. The impact of that, businesses borrow or don't borrow second adjustable consumer loans tied to the prime rate, such as credit cards. Fed monetary policy example, second effect, few weeks, rates on mortgages, autos, and construction loans either go up or down, depending on how they adjusted it. Fed's monetary policy example, third effect is investors move their cash into or out of the stock market from bonds. Fed's monetary policy example, the goal here is either to have laid off workers or regain the jobs and increase unemployment. Okay, so it just depends, of course, which way they adjust that. All right, that concludes our presentation on mortgage rates. So again, my name is Sean. Texas, Oklahoma, or Florida, please give me a call and I would be happy to help you out. Have a great day.